Just weeks ago, SK Hynix broke the rules of the memory business. $55 billion in 3 months at a 76% operating margin. It controls 62% of the memory every Nvidia AI chip depends on. The quiet monopoly at the heart of the AI trade. And in that same week, the market turned on it. Almost half its value, $600 billion, the worth of SpaceX, gone in a month. $600 billion on record earnings. How does a company have its best quarter ever and lose $600 billion at the same breath? The answer isn't in the profits. It's in the price of survival. A $31 billion spending trap. A valuation braced for a bust, and China about to flood the market. This is the first real crack in the AI trade. To understand why the market panicked, you have to understand what SK Hynix actually sells. Because it isn't the famous part of an AI computer. When people picture artificial intelligence, they picture Nvidia's chips. But a processor on its own is just an engine with no fuel line. To think, it needs to hold enormous amounts of data right beside it, moving at almost unimaginable speed. That's what high bandwidth memory does. It's the fuel line feeding the engine, and it is fiendishly hard to build. HBM isn't one chip, it's a tower of memory dies stacked vertically, a dozen or more, then wired through with thousands of microscopic vertical connections and bonded without a single flaw. Get one layer fractionally wrong, and the entire stack is scrap. It's less like printing a chip and more like assembling a skyscraper, where every flaw has to line up to within a fraction of a human hair. Which is why roughly 62% of it comes from a single company. Micron sits near 21%, Samsung around 17%. One company controls the memory AI runs on, and for Nvidia's newest systems, analysts at UBS expect SK Hynix to supply as much as 70% of the high bandwidth memory. When the world set out to build artificial intelligence, this Korean company quietly became its one essential supplier. And that position turned a manufacturer into something far more powerful. SK Hynix didn't just meet the demand for AI memory, it captured it. With pricing power that effectively turned a hardware maker into a toll booth for the entire AI industry. Every model trained, every chatbot scaled, every data center switched on, pays the toll. On paper, that made SK Hynix look bulletproof, a near monopoly, selling a sold-out product to the fastest growing industry in human history. So why, at the exact moment it proved all of that, did roughly $600 billion walk out the door? The first answer came from an unexpected place. In late July, a report from the tech outlet. The information showed investors the exact blueprint for how this monopoly gets dismantled. China, it said, had made real progress mass-producing its own advanced chip-making machines. The deep ultraviolet, or DUV, lithography tools used to print memory. The one thing that kept SK Hynix untouchable, the sheer difficulty of making these chips, might not stay difficult forever. The market's imagination did the rest. If China can build the printing presses, China can flood the world with cheap, state-subsidized memory. And then a second story sharpened the fear. Apple, one of the largest chip buyers on the planet, was reportedly lobbying for approval to buy memory from a Chinese producer, CXMT. The message investors heard was cold and simple. SK Hynix's own customers are already shopping for the exit. That Tuesday, the stock fell almost 15% in a single day. And to understand why those customers were shopping, you have to see the quarter from their side. The same shortage that produced those record profits was, for everyone else, a tax. Memory has been scarce, and SK Hynix used that scarcity to raise the prices it charges buyers from Apple to Nintendo. Every extra point of margin in its 76% came out of somebody else's budget. SK Hynix had become so profitable, taking such a large share of the money moving through the AI supply chain, that its own customers began to resent it. As Andy Wong, who helps run multi-asset strategy at Pictet Asset Management, put it, "The debate now is whether memory is taking too much of the pie." His fund had already been trimming its position. It's a subtle, dangerous idea. Squeeze a supply chain hard enough, and you hand every customer a permanent reason to fund your replacement. Apple isn't lobbying for Chinese memory despite SK Hynix's record quarter. It's lobbying because of it. But a single news report doesn't erase $600 billion. The China scare was only the spark. The next day, SK Hynix reported those record earnings, and the selling got worse. There's a surface answer to what happened next, and it's almost banal. The record wasn't record enough. Analysts had penciled in something closer to $58 billion of revenue, and around $44 billion in operating profit. SK Hynix came in under both. Its profit had risen 557%, and still fell short of what Wall Street had already decided it would be. On the day it reported the best quarter in its history, the stock fell another 19% in Seoul. That is what priced for perfection actually looks like. But a miss of a few percent doesn't erase $600 billion. To understand a number that big, you have to look at what SK Hynix is being forced to do, just to stay in the lead. Alongside those record results, the company told investors it would raise its capital spending this year by roughly 50%, to at least $31 billion. That is about $85 million a day, every day, for a year. Put another way, SK Hynix now expects to plough somewhere around a third of everything it earns straight back into factories and machines. And it can't stop. This is the cruel logic of memory. Every rival's racing to build the exact same capacity at the exact same time. Spend too little, and you lose the technology lead that makes you special. Spend too much, and everyone arrives at the finish line together with far more supply than the world needs. The industry has a word for this, a glut. And if you know where to look, Wall Street is already screaming that it's coming. Even after this record quarter, investors are only willing to pay about 3.7 times next year's expected earnings for the stock. A month earlier, they were paying nearly double. Its rival Micron trades at over 6 times. Think of a valuation multiple as a measure of trust. If someone offers to sell you a mansion for the price of a shack, you don't assume you're getting a bargain. You assume the foundation is sinking. In finance, a multiple this low on a company this rich isn't a sale, it's a fire alarm. Wall Street is looking at these historic profits and betting they're about to implode. And investors have every reason to believe it, because this exact company has done it before. Just 3 years ago, in the last downturn, SK Hynix lost about $6 billion in a single year, its first annual operating loss in a decade. Bleeding red ink for 4 straight quarters. Same factories, same executives, same industry. Record profits to record losses in barely 12 months. Because the memory business doesn't glide down. It falls off cliffs. And this is where the story earns its other side. Because the bull case is genuinely strong. And it comes from people who know this industry far better than the panic does. SK Hynix's answer is that this cycle is different, and that they've engineered it to be. Instead of selling into a volatile spot market, the company says it's locked in multi-year agreements with around 10 major customers, pricing and volumes committed years in advance. They sold the future before they built it. The boom and bust, they argue, is being smoothed on purpose. And the new capacity isn't speculative. It's staged against confirmed orders. And the demand behind it is not hypothetical. Just last week, SK Hynix's parent group signed a partnership with Nvidia spanning deals worth more than $500 billion. A figure that includes Nvidia buying memory. The company has begun mass-producing HBM4 ahead of its rivals, with the next generation promised to Nvidia in bulk in 2027. And on the earnings call, management was blunt. They see no end in sight to demand. Both the chairman and the chief executive have said publicly they expect the memory shortage to run beyond 2030. And on the very question at the heart of this video, the 2027 glut, serious analysts flatly disagree with the market. Sanjeev Rana, head of research at CLSA Securities Korea, argues that 2027 will be a year when memory supply is still very tight, and that after a correction this severe, this is a buying opportunity, not a warning. As one analyst put it, the AI memory story hasn't broken. Expectations had simply moved ahead of what even another record quarter could deliver. It's a coherent case, and an uncomfortable one for the bears, the dominant company in the most important industry of the decade, selling a product it cannot make fast enough. Suddenly on sale. But there's one thing the bulls can't fully answer. A multi-year contract protects you from this year's price war. It does not protect you if the customers themselves stop building. Contracts are only as solid as the buyer on the other side. And every one of those buyers is funding its AI spending out of profits it hasn't earned yet. And that is the question SK Hynix cannot answer alone. Because the answer lives one level up, with a handful of companies actually paying for the AI boom. Because this was never really a story about one Korean chip maker. SK Hynix sits at the bottom of the AI pyramid, which makes it something rare. An honest thermometer. It has no software dream to sell, no chatbot to demo. It simply reports how much the world is actually paying to build AI in hard dollars every quarter. And what its stock is now whispering is uncomfortable. The whole build-out rests on a single bet, that the companies renting out AI will eventually earn back the trillions being spent on the hardware. Every layer of this pyramid is currently spending tomorrow's returns today. And SK Hynix's $31 billion budget is just the layer you can see. Already investors have begun to whisper that some of the biggest spenders are building more data centers than they can fill. That's the real crack the market is probing. Not whether AI works, but whether the returns will ever justify the spending. The unsettling possibility is this: the AI software revolution could succeed, and the hardware supercycle underneath it could still break, buried under its own cost. That's what $600 billion wiped out on a record quarter is trying to tell us. The most profitable company in the boom just became the first place you can see the doubt. So, does the record prove the AI trade is stronger than ever? Or does the sell-off mean the smartest money is already backing away from the memory that makes it all run? I genuinely want to know where you land. Tell me in the comments. Because SK Hynix only answers half the question. It shows us the supply side is stretched to its limit. The other half, whether the companies spending the trillions can ever make it back, is a story of circular deals and dizzying promises at the very top of the AI world. That's the next one. The first crack usually shows up in the strongest wall. See you in the next one.